In this video, we are going to have a brief discussion about the impact of IFRS 16 on certain key performance indicators. So we would be discussing about 7 key performance indicators. For example, the impact on EBIT through the introduction of IFRS 16 in the books of lessee, and in EBITDA, in debt equity ratio. So in this video, we're going to have a brief discussion about what is the impact on these certain key performance indicators by the introduction of IFRS 16. So IFRS 16 is a very substantial change, is bringing substantial changes in the books of lessee, because it requires each and every leases to be capitalized, apart from certain exemptions like short-term leases or for low-value leases. So in majority, all the leases, there is no concept of operating lease and financial lease in the books of a lessee. So we need to capitalize all the expenses or all the lease expenses. There's no off-balance sheet financing through, like if we introduce IFRS 16 to the picture. So IFRS 16 is implemented it will get implemented from 1st January 2019. So all the books of accounts which are beginning from 1st January 2019, they need to comply by IFRS 16. So I prepared an example for you, like we will go through a particular example, and so that we can have an understanding of how the impact, like how IFRS 16 is going to have a substantial change in certain key performance indicators. So let's start the journey. Here you are able to see in Excel, I've taken an example of a lease operating, which was there previously as an operating lease. So there's total 5 years in the lease. I will go very slow on this because it requires some calculations. So I will go very slow. Think about a lease. The total term of the lease is 5 years and the annual lease payment is 100,000 or 1 lakh in Indian terms. It's 1 lakh. 1 lakh currency unit. This is the lease payment per year. 1, 2, 3, 4, 5. And the total tenure of the lease is 5 years. So what I did, this is total lease payment. Under the current regime, we need to show a lease payments or lease expenses. I'm not talking about any lease incentive. Straightforward, plain vanilla lease. No balloon, nothing. Plain vanilla lease is 1 lakh, 1 lakh, 1 lakh. We need to recognize expenditures every year as 1 lakh currency unit under the current scenario, under the current IAS 17. But as required under IFRS 16, we need to capitalize the right to control the use of a particular asset, of a particular identifiable asset. So we need to capitalize it. For capitalization, we have to discount these lease payments on the basis of a particular discount rate. I've taken 10% as a discount rate to be very easy and precise. 10% discount rate. If I discount all the cash flows by 10%, I'll arrive at 379,079. So 379,079 is the amount by which I have to capitalize the previously called operating lease in the books of lessee. So in a nutshell, there is a lease contract. The term of the lease contract is 5 years. The annual lease payment is 1 lakh or 100,000. I discounted the lease payment through the help of a discounting rate that is 10%, and I've arrived at a capitalized amount to the tune of 379,079. So the basic journal entry for this. So I'm telling you the basic journal entry to capitalize this asset in the books of lessee would be right to use the particular asset account debited to lease liability to the tune of 379,079. 379,079. 379,079. This is very easy. I did nothing fancy. This is just a requirement under IFRS 16. So I need to capitalize the lease. Then we will move forward and I prepare a lease amortization schedule. It is nothing but a loan amount. Think 379079 is a loan amount, and I prepare this amortization schedule like years, opening balance 379079 multiplied by 10%. This is the interest rate. This is the this is the payment made, and this is the principal portion and the closing balance. This is a basic loan amortization schedule, and I'm concerned about year one because here we are discussing only for current year. So my understanding would I need your attention is only in year one. So in year one, at the beginning of the year, the total opening balance is 379079 as a lease liability. My implicit rate of return is 10%. So interest expense is coming out to be 37908. The payment that is made like 1 lakh currency unit. So 1 lakh minus interest expense is coming out to be principal and the closing balance. This is the closing balance at the end of the year. So till now this is clear. Now let's think about the lease expenses. This is the most crucial part that we are discussing. This is basically a time series basically a time series that I prepared and showing the expenses that we need to recognize in over the course of action, that is like under IAS 17, which is the current regime, and under IFRS 16. So this sheet will give you an idea about what are the lease expenses that we do recognize under the current regime and we will recognize under IFRS 16 implementations. So under IAS 17 it's quite simple. All the lease payments, I'm not talking about any lease incentive, nothing, no complexity, only a plain vanilla lease. All the lease expenses, like my lease was for 5 years and the annual lease payment is 1 lakh currency unit or 1 lakh rupee, whatever it is, and this is the lease expense. This is quite easy, we don't need to do anything. But the complexity begins here under IFRS 16. What we need to do under IFRS 16 is, this is a right to control the use of an asset. Here this is an asset, right? This is an asset. This assets covers under IAS 16. IAS 16 deals with PPE. So you know what we need to do is we need to depreciate this asset. We need to depreciate the right to use a particular asset over the course of the lease term. I'm not going to discuss about the lease term or the life of the asset, whichever is lower, that you're going to have a discussion on the leases chapter, because I assume you know something on IFRS 16. So we have to depreciate the asset. I have depreciated the asset over the lease term of 5 years. So I need to depreciate 379079 over the course of 5 years. So what I did, I depreciated it over the course of 5 years. So my depreciation expense is coming out to be 37816 per annum. If I total this, the total is coming out to be 379079. We need to book total expenditures as 75816 as a depreciation expense. Now the second one is the interest expense. Interest expense is nothing but a finance cost that we need to charge in year one. The interest expense is coming out to be 37908. 37908 is coming out. Second year 3169924869 and it's going on based on it is. See, it's reducing. It's basic finance. When you are making a lease payment, it includes both principal and interest component. So your interest will go down because you're paying something here. So over the course of action, the interest expense will have a declining balance because interest expense will come down because you're paying in your principals. So till now the example is clear. I have a lease term, 5 years, 1 lakh lease payment. I have prepared a lease amortization schedule. So under IAS 17, I will book straightforward 1 lakh as a lease expense. But when I'm coming to IFRS 16, there are two types of expense that we need to break into. The lease expense is broken down into two parts. The first one is the depreciation, the second one is the interest. So in a nutshell, if I want to summarize, the second sheet is under IAS 17, the operating lease expense is broke down into two parts under IFRS 16. Under IFRS 16, it is broken down into two parts. The first part is the depreciation expense of the lease liability plus the finance cost. So previously under IAS 17, I was booking expenses of the operating lease. Now I have to book depreciations and finance cost as an operating lease or as an expense. So if you can see, there is a difference. In year one, there's a difference of 13,000 in the financials. There's a difference of 1,07,000, and if it is going on declining, because the impact is due to interest rate, because depreciation is same all across the 5 years, because it is due to the interest expense. And one more thing, if I add all of them as 5 lakh, it's only have an impact on the timing to book the expense. It do not have any substantial change in the total expense. I have an expense of 1 lakh, I will book an expense of 1 lakh total. No, sorry, I have an expense of 5 lakh, I will book an expense of 5 lakh in totality. But the recognition of the expenditures over the period will change through the implementation of IFRS 16. So till now we have understood that under IFRS 17 we need to book, under IFRS 16 we need to book two expenses: depreciations for the right to control the use of the asset we need to depreciate, and the finance cost. This is basically a finance lease kind of an understanding. And under IAS 16 I used to book only the lease expense. Now I'm going to have a discussion on what is the impact. This is the basic discussion. This is my main course of discussion. So what's the impact of IFRS 16's implementation in a lessee's financial statement? So let's start. I have assumed that the entity is earning 5,60,000 per annum, or for during the period the earnings are 5,60,000, which are before interest, tax, depreciation, and lease expenses. Mark my words, lease expenses. I've highlighted in red. So 5,60,000, because I want to make a reconciliation, or I want to specify what's the difference between the two recognition standards. So interest before tax, depreciation, and leases is 5,60,000 in IAS 17 and IFRS 16. So there is a lease expense of 1 lakh in the current year, because I need to pay 1 lakh rupees as a lease expense. See, under IAS 17 I need to book a lease expense here. I need to book a lease expense here as 1 lakh. But under IFRS 17, under IFRS 16, the lease expenses the lease expense is replaced by depreciation expense and interest expense. So the operating lease expense is not there, which is replaced by depreciation and finance cost. See, so there is no lease expense here, but there is a depreciation expense to the tune of 75,816 that I've came across, like that we have divided by 5 as on a straight line basis. So this is earning before interest and taxes. You can see there is a substantial difference between EBITDA. This is basically EBITDA, right? Because I have deducted the lease expenses and there is no lease expense in IFRS 16. So the EBITDA is coming out to be 5,60,000 under IFRS 16 because there is no lease expense. But under IAS 17, the EBITDA is 4,60,000 because we have a lease expense to go. So my first objective here is there will be an increase in the EBITDA. If we are applying IFRS 16, there will be an increase in the EBITDA because I need to book a lease expense under IFRS and under IAS 17, and there's no concept of lease expenses in IFRS 16. So technically there's an increase to the tune of 1 lakh in this current scenario through the help of through introduction of IFRS 16. Now coming to picture the depreciation expense. So there is no depreciation under IAS 17, but there's a depreciation expense under IFRS 16. So what we need to do is we need to deduct the depreciation expense to come out at a figure called EBIT, earning before interest and taxes. So I've just said lease expenses will always be more than the depreciation, because lease expenses comprises depreciation and finance cost. So operating lease will always be higher than depreciation and your finance costs in individual, and in totality they are approximately the same on the long run. So as I told you, the lease expenses will always be greater than the depreciation expense, because depreciation expense is a subset of lease expense under the IFRS 16 concept. So depreciation will always be lower as compared to lease expenses, provided I'm assuming a straight line method of depreciations to avoid any kind of complexity. So there will be an increase in EBIT also. If you can see, the EBIT is jumped up by 24,184 as compared to prior period because of the introduction of IFRS 16. And now the lease expenses, the interest expenses, because there is no concept of interest expense in IAS 17. I have deducted 37,908. How I arrived at 37,908 is from here. This is the first year, right? The interest expense is 37,908. I'm assuming everything is in cash. It's cash transactions. 37,908 is the total lease expenses, no accrual accounting. This is total cash basis. Because, I'm going to explain why I'm giving this caveat. So if you can see, there is a reduction in EBT through the introduction of IFRS 16, because there's a basic finance in any loan. The beginning period's interest will be higher because the principal part are very much higher. So this is one of the more important point that I want to convey is, during the opening period, or during the new introduction period, the EBT, earning before taxes, will be lower under IFRS 16 because of the heavy interest expenses. And the difference is to the tune of 13,724. So here the total nutshell is, the nutshell I want to explain is, through the help of introduction of IFRS 16, there will be an increase in EBITDA, there will be an increase in EBIT, and there will be a decrease in EBT, earning before taxes. And I'm assuming a straight line depreciation method, no complexity, nothing. So now I'm going to explain you the impact of IFRS 16 on the cash flows. So this is a basic cash flow, right? I'm assuming everything is in cash. So 4,60,000 is operating cash flows, and operating profit as 446,276. So these are operating cash. I have to change. This is. I'm taking a operating profit. I've changed it. So I need to add a depreciation expense because it's a non-cash expense. This expense, I need to add them up because it's a non-cash expense. I need to add them up. So there is no concept of depreciation here in IAS 17. So on totality, the cash flow from operating activity has gone up to the tune of 62,092. So which means, on a nutshell, through the help of introduction of IFRS 16, if we are applying, there will be an increase in the cash flow from operations, because there is a concept of depreciation that we need to add, and previously we need to deduct the whole expenses here under as a part of lease expense. But here the lease expense is broken down into two parts. I have taken the interest component as an operating expense. This can be shown as a financing expenses as well, and the principal payment I'm showing as a financing activity. So I've taken principal payment from here, 62,092. So in totality, this is the operating profit, 446,276 under the current regime, under the IFRS 16. We need to add the depreciation expense because it's a non-cash item. So through introduction of IFRS 16, there will be an increase in the operating activity, in the cash flows from operating activity. So there will be a decline in the cash flow from financing activity, because all the principal lease payments going to come into under under the cash flow from financing. This would be a cash outflow from financing activity, and the interest expenses could be treated as a depreciation, could be treated as an operating or financing activities. So in a nutshell, in order to summarize everything, if I apply IFRS 16, there will be an increase in the EBITDA, there will be an increase in the EBIT, there may be a decline in the EBT. Because of the heavy interest expenditures in the initial period, there will be a decline in the EBT. Second, the cash flows, there will be an increase in the cash flow from operating activities, because there is a component called depreciation being added up. So so as a part of non-cash expenses, I need to add them up, and the principal payment. And the principal payment will be forming a part of cash flow from financing activities, and interest expense can be treated as an operating activity or financing activity as well. So these are major three indicators that we have discussed. Now we're going to have discussion about some other indicator. Another indicator for which we need to have a discussion is the asset turnover ratio. The entity is utilizing its asset per rupee of asset, or for example, if they have implemented 1 lakh average total assets, and they are generating 60,000 out of it, so they are for each rupee of a fixed asset investment, they're able to get only 0.6 rupees of turnover. So this is basically what asset turnover ratio says. So through introduction of IFRS 16, the turnover will remain the same, because this is the same asset that they are going to use, they were previously using, because there is no change in substance over form, but there is a change in the total assets, because we need to book an asset, the right to control the use of an asset. It's basic mathematics. The denominator has gone up, numerator remains the same, so the asset turnover ratio will fall. So this is the fourth characteristics that I want to explain, is through the introduction of IFRS 16, there going to be a decline in the asset turnover ratio. They're going to be a decline in the asset turnover ratio. So we've discussed on another ratio is called debt equity ratio. Debt equity ratio. Debt equity ratio means debt, long-term debt over equity. So if I introduce IFRS 16, I need to book a lease liability which was not there previously, and nothing in the equity balance. So here comes the basic mathematics. The numerator goes up and the denominator remains the same, so debt equity ratio will go up. So debt equity ratio will go up. So on an overall basis, these are some 5 indicators that we have discussed now. And I want to discuss about 2 more indicators which are a bit conceptual and depends on some circumstances. For example, return on capital employed. So return on capital employed, I'm taking, suppose, EBT divided by your average capital employed, because there's going to be a change in EBIT and there's going to be a change in the capital employed because of debt component and because of interest component. Basically, in the initial period, the EBIT will fall and the average capital employed will rise. So in the initial period, the ratio will have an adverse impact, or the ratio will come down. But after that, the capital remains the same, or capital will decline due to the lease payments, and the EBIT will go up because the interest expenses will lower down. So in the future years, the EBIT will rise and the average capital employed will fall because of the lease repayments, principal repayments. So this totally depends on the entity to entity. For this simple example, I can say the return on capital employed ratio, if I say in the long run, it will fall, it will fall, it will fall, it will fall. So it will like from from here it will fall, and then it will going to rise in the near future. So this is the total discussion on IFRS 16. So in order to summarize everything that we have discussed now, a recap is very necessary. So let's start. The first discussion we have is on EBIT, or let's start with EBITDA. EBITDA due to depreciation component and due to interest component. This is before the items and there is no lease payment. Through the help of IFRS 16's introduction, it will go up. The second one is EBIT. Because there is an interest component and depreciation is always less than the operating lease expenses which we used to book, it will go up. So the third one would be debt equity ratio. The debt will go up and the equity remains the same, it will go up. The fourth one, operating cash flow. The operating cash flow will go up because we have added the depreciation expenses, a non-cash item, and no expenditures booked in terms of lease repayments. But there will be transactions in terms of, there will be lease payments in terms of cash flow from financing activities. Because of the principal portion, it will fall down. But the cash flow from operating activity, it will rise. The four items that we have discussed till now, let's discuss about the rest. Now the fifth item we've discussed is asset turnover ratio. The asset turnover ratio in case of total asset turnover ratio, the turnover will remain the same, whereas the average total assets will rise up. So there is a decline in the asset turnover ratio, and two more ratios we've discussed is return on capital employed, and basically one ratio, that is return on capital employed. So it depends, but based on our example, or in order to simplify the situation, ROC will fall down because of the decline in EBIT, because of high interest expenses and high debt values. Then over the course of X1, when there will be a repayment in debt, this will fall down. The EBIT will rise, and the average capital employed, or average long-term capital employed, will fall down. So on a long term, it will go up. So this is the total movement that we have discussed on this video. So in case of any queries, just let me know.